Hello and welcome to Wall Street Wisdom. Today, we need to have a serious conversation about something that could cost investors a lot of money if they're not paying attention. There are stocks right now that people are buying without realizing the risks, and in this video, I'm going to break down why you might want to stop buying these stocks before it's too late. A lot of people get caught up in the hype chasing stocks that have already skyrocketed or companies that seem like the next big thing. But not every stock that's popular is actually a good investment. Some of them are extremely overvalued, some are in declining industries, and others might be straight up dangerous for your portfolio. If you're serious about growing your wealth and protecting your investments, you need to know which stocks to avoid. So let's talk about it. Right now, we're seeing a market where some stocks have been pumped up beyond their real value. Investors are throwing money into companies just because they have flashy headlines, but when you actually look at the fundamentals, that's not looking good. A great example of this is what's happening in the tech sector. Over the last few years, tech stocks have dominated the market, and companies like Tesla, Nvidia, and Meta have seen massive growth. But here's the thing, not all tech stocks are built the same. Some of these companies have strong cash flow and solid balance sheets, while others are burning through money with no real profits in sight. And that's a huge problem. When interest rates were near zero, companies could afford to borrow as much as they wanted to grow their business. But now, with interest rates staying high, the cost of borrowing has gone up, and a lot of companies that relied on cheap money are struggling. Take a look at some of the smaller, unprofitable tech companies. A few years ago, investors were pouring billions into these companies because they believed in their future potential. But fast forward to today, and many of them are still losing money, cutting jobs, or barely holding on. Then there's the electric vehicle sector. Everybody saw what happened with Tesla and wanted to find the next big EV stock. But just because Tesla succeeded doesn't mean every EV company will. Look at companies like Lucid and Rivian. While they have great technology, they're still losing billions of dollars, and demand for EVs has been slowing down. The problem isn't just competition. It's that these companies are still struggling to scale production and turn a profit. And if they can't make money, they'll eventually have to raise more cash by issuing more stock, which dilutes existing investors, or by taking on more debt, which makes things even riskier. Another big red flag in the market right now is the hype around AI stocks. Don't get me wrong, artificial intelligence is going to change the world, and there are definitely AI stocks that will make investors a lot of money. But here's the danger: when a trend becomes popular, everyone wants in, and it drives stock prices up way too fast. We saw this happen during the dot-com bubble in the early 2000s. Companies that had anything to do with the internet were getting crazy valuations, even if they weren't making money. And what happened? The bubble popped, and a lot of those stocks never recovered. Right now, we're seeing the same thing with AI. Companies are adding AI to their name just to attract investors, even if they're not actually doing anything groundbreaking. If you're buying AI stocks, make sure they actually have a real business model and a clear path to profitability. And let's talk about meme stocks. If you've been in the market for the last few years, you know exactly what I'm talking about: GameStop, AMC, Bed Bath & Beyond. These stocks were pumped up by retail traders, and while some people made a lot of money, many more lost everything when the hype died down. The problem with meme stocks is that they don't move based on fundamentals, they move based on hype and momentum. That might work for short-term traders, but if you're investing for the long run, you do not want to be stuck holding a stock that has no real future. Another group of stocks you should be cautious about are high-dividend stocks that seem too good to be true. A lot of people see a stock with a 10 or 15% dividend yield and think, wow, I can make so much passive income. But the reality is, if a dividend is that high, there's usually a reason. Either the stock price has crashed or the company is paying out more in dividends than it can afford. That's a huge red flag. A sustainable dividend yield is great, but if a company is constantly borrowing money just to pay dividends, that's not a good investment. And finally, let's talk about IPOs. Initial public offerings can be exciting, but they can also be dangerous. A lot of companies go public not because they're ready, but because their investors want to cash out. When a stock first hits the market, it's often priced based on hype rather than reality. Just look at what happened with companies like Robinhood, Peloton, and Beyond Meat. These stocks were red hot when they went public, and a few years later, they've lost most of their value. The truth is, many IPOs are overhyped, and the people making the real money are the early investors, not the retail buyers who jump in after the stock starts trading. So what should you do as an investor? First, don't chase hype. If a stock is getting a lot of media attention and everyone is talking about it, that's often a sign that it's already overvalued. Instead, look for companies with strong fundamentals, steady revenue growth, solid profits, and a clear competitive advantage. Second, always do your research. If you don't understand how a company makes money or why it's valuable, you shouldn't invest in it. And finally, be patient. The best investment opportunities don't come from chasing trends. They come from finding great companies at fair prices and holding them for the long run. At the end of the day, investing is about making smart decisions and avoiding unnecessary risks. There will always be hot stocks that everyone is talking about, but just because a stock is popular doesn't mean it's a good investment. Focus on companies with real value, stay disciplined, and don't let FOMO drive your decisions. Now, I want to hear from you. Have you ever bought a stock that turned out to be a bad investment? Let me know in the comments. And if you want to stay ahead of the market with real, no-nonsense investing advice, make sure to subscribe to Wall Street Wisdom. Thanks for watching, and I'll see you in the next one.